Our earnings coverage is not over, far from it. Let's talk now about Raymond James Financial. The stock not much changed after it reported after the bell yesterday. Did miss estimates on the bottom line, but did see record highs in multiple areas of the business, including loans and private client group assets, as well as some moves in the M&A department. Let's welcome in Paul Reilly, Raymond James CEO. Paul, it's good to see you. Thanks for being here. I do want to address the earnings miss, first of all, because it did have to do with some loan loss provisioning, if I understand it correctly. Can you walk us through that?
Yes, so Julie, it's always great to be with you and Brian. Yeah, the miss was really result of good things. That the loan loss reserve was because we had high growth in loans, 7%. And when you put a loan on the books, you put a reserve up front on it. So had loan growth been slower, the reserve would have been lower and the earnings would have been better. But ironically, those loans are what create future earnings. So it's really, the accounting impact of putting a reserve when you make loans, and loan growth was very, very good. And the second piece of most of that, what people would call a miss, was a difference in the effective tax rate due to complicated. We use corporate-owned life insurance to fund some of our plans. And when the market's down, the rate goes up. When the market's up, the rate goes down. So if you strip those out, it'd be right on. And more importantly, with kind of record private client group assets, record loans, we got criticized for kind of when rates were going down and not locking in rates. And so we didn't want to lose the upside. The next 100 basis point rise in rates should be about 600 million pre-tax additional earnings for us because we kept our balance sheet flexible. So I believe we're in a really good position. So I think it was a very good quarter for us and kind of showed the strategy we've had over the last few years is really paying off.
Paul, I just want to lock in on that number you just mentioned. So as rates rise, how many rate increases would it take to deliver that profit number you just mentioned?
So it's 100 basis points. The first 100 basis points generally is part of the cost, benefit we absorb for everything we do. Now that's been missing for the last couple of years. So the first 100 basis points, we keep almost all of that. So 25 was, already raised, but that didn't really affect this quarter. It'll start next quarter. And so the next 75 basis points of raises, which most people anticipate is the next two, if they're 50 each, will really hit that number if cash balances stay where they are. And then after that, we start sharing it. So it's still an increase, but less of an increase as we make sure that we're fair to clients and share, those rates. So again, a big driver for us. Also that we're very high capital. We're over twice the regulatory minimums, which a lot of people wish we deployed more capital, but we've announced 3 acquisitions. And we believe capital gives you the flexibility. Some people with less capital have a harder time dealing with the influx and the exit of cash. And we just look very, very long term. So again, well positioned for rates and for the environment if it goes down, the macroeconomic environment.
Paul, of course, those rate hikes are contingent on the health of the economy. And we got a negative read on the health of the economy this morning, 1.4% decline in GDP. From your standpoint, can the U.S. economy handle more rate hikes, just given what we saw in the first quarter?
Yeah, the problem is the Fed. I mean, it's always easy to look back, but most of us in the industry are saying rates should have started going up earlier. And that, if you slowly move rates, people adjust, and I think inflation would have stayed down. I don't think anyone expected the pandemic change. If you look at most of the negative GDP, it was driven by 2 things. One, inventories. I mean, anyone who's trying to buy a car, I even had a dishwasher in a house. They said it would take a year to get it. It was through the supply chain. That's hurt sales. And imports are up and exports are down. So those were the 2 biggest chunks. If those were more normalized, we would have had a positive GDP. So I do think rates are important to go up, really to fight inflation. And the problem is we have to do it. We should have started sooner, and we're going to have to do it quicker, which is going to create some disruption. So I think the sooner it gets there, the better, and let it settle out and let the economy settle out.
Looks like you're going to have to apply some more elbow grease on the dishes a little bit longer there, Paul. I am curious from your perspective because as someone who runs a bank, you have a lot of tendrils in different aspects of the economy. So looking at that, what we saw in the first quarter, but also looking ahead to all of this talk about a recession at some point in the next couple of years, what are you seeing? What are your clients telling you, and what are they doing?
I think clients in the market are nervous. The good news is, the over 90% of our clients say they're comfortable on their plan. So a lot of our growth is really due to our financial advisors. Really, net new assets, 9% annualized for this quarter is really industry leading, as it has been for the last year. And I could take credit for that, but that wouldn't be right. It's our advisors and what they're doing for their clients and attracting assets. So I think everyone is nervous. If you look at the numbers, everybody says you expect a correction. It's been a long time since really '09 when we had our last adjustment. So you expect some kind of down. But the numbers, the consumer spending, which is still going up, and there's still high demand, it doesn't look like there's going to be a short-term, downturn in terms of the economy. So, but everyone's nervous. Valuations historically were high in the market, and people are nervous, and certainly now you add the geopolitical risk, what's happening in the Ukraine, and every piece of news is concerning. But if you look at it, I think we should be okay. Now, the inflationary pressure is real. It impacts people's lives. It's going to impact costs, as employment costs will grow, and that generally gets passed on. So you have to break that cycle of inflation to really get people comfortable enough. So it's going to be a little while to adjust, but I think we're actually in good shape.
Paul, irrespective of that nervousness among clients, you look to have had a good quarter in M&A. That wasn't the case at some of your larger rivals. What's going on there?
Yeah, it's down, but through December was just an industry record, and certainly a big record for us. And I think part of it is valuations were good, debt was cheap, and people were concerned about tax laws, and a lot of people monetize things before year end. So that may be a cyclical peak in terms of volume. So it's down, but it's still pretty good. And I would say what the question right now is geopolitical concerns. How is that going to impact the economy? And also with valuations down a little bit in the market, that's caused a slowdown. But if you really look at us, and I really think the industry, is most of the mandates and backlogs haven't been canceled. They've been on pause. Certainly things are closing, new things are coming to the market, but people are just being more cautious, trying to get a read on this rate increase ride, the effect of the economy, and certainly, what's happening again in the Ukraine has got people nervous, as it has all of us. So, but right now I call it a pause. So I would expect it to come back as long as the markets perform well and things don't get worse.
Always great to get some time with you. Raymond James CEO Paul Reilly. We'll talk to you soon.
Thanks, Brian.